Hey, it's Saretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you get sort of value or intimate out of the video, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. We've got lots to touch on today. We've got everything that's happening in the UK, how that impacts the Canadian economy, financial markets. Not only that, but we've got some important news that's happening in the Canadian mortgage space. Immigration numbers going to help you put together the whole package so you understand exactly what's going on right now. But we got to start this off with the elephant in the room, which is the UK. Obviously, the currency has been taking a beating lately. They're in the midst of an energy crisis. And of course, now we have interest rates rising at a fast clip. The UK bond market, the long end, basically yields surging higher, which basically means interest rates up, bond prices down. So interest rates surging, actually getting to crisis levels where it actually prompted the Bank of England to step in with quantitative easing. Where have we heard that word before? QE is back, and it's back in the UK because the entire pension system in the UK almost completely imploded just this week. So very, very important happenings. I think it really just goes to show you again, guys, that we are, yes, we talk a lot about, the Canadian housing bubble. Again, who really cares? It's a country of 38 million people. What we're talking about really from the bigger picture is a global sovereign debt bubble with not only governments around the world indebted, households, businesses, corporations, everyone has loaded up on these ultra low, ultra cheap interest rates over the past, 10, 15 years. And so you can't suddenly just normalize interest rate policy without blowing a lot of things up. And I don't know about you, but blowing up the entire country's pension plan or pension system probably isn't going to sit well with society. So it prompted the Bank of England to step in with quote unquote unlimited amounts of QE to basically provide liquidity to that market. So imagine this: the UK, the Bank of England, is now running quantitative easing, which they say is temporary. Again, these are always temporary programs. Don't forget that we were doing QE for 10 years, actually longer than 10 years post 2008 global financial crisis. So temporary program to provide liquidity. Then they're running this program with inflation running at 10%, expected to move higher. So it is a mess. And this is actually prompting, obviously, contagion-like effects. We have some updates here from certain Fed officials now worrying about financial stability concerns. There's been discussions around, could this potentially filter through into the U.S. pension plan system? Again, there's never just one cockroach, so this is inevitably going to trickle through into other major markets. But I think what this is it's signaled a very pivotal point that central banks again had to come to the rescue. The system simply doesn't seem to be allowed or isn't able to function on its own. It is requiring continued amounts of quantitative easing. And this is again coming back to that long-term debt super cycle. And so this is obviously going to have ramifications for the Canadian economy. When you have a massive developed market like the UK facing these sort of problems, you have to remember the problem basically is that these pension funds, these pension plans are mandated by government regulation to actually buy a fixed amount of government debt. They have to basically offset their liabilities years and decades down the road, and they are mandated. They can't just be in 100% equities and 50% precious metals. They don't operate like an individual retail trader that's sitting at their desk at home. These are massively regulated institutions. And so they've been required to basically buy government debt over the past 2, 3, 4 years at these extremely basically zero interest rates. And all of a sudden, interest rates rise exponentially. Not only that, the value of the underlying bonds basically falls. And so this is creating all these systemic issues, which again is kind of what we talked about on the show, on the Looney Hour. And so I think that, and it's certainly one of my interviews that I had with Professor Steve Keen, we also talked about this, which is that this rate hiking crusade, while yes, I understand it is necessary to get inflation down, I think it's naive to think that it probably won't end in some sort of financial crisis or mishap. And that's really been the thesis all along. And so that's not to say, hey, it's time to get bullish, on Canadian housing. But what it's saying is like, listen, guys, like you can't just normalize policy without something blowing up. And sometimes that thing blowing up becomes a systemic problem that governments have to step in, which is, again, if your pension system is blowing up, I mean, let's be honest, they're not just going to let it blow up. It's the country's pension plan system. And so I kind of apply that to the same of like Canadian housing, like the idea that we're just going to let rates float to like 8, 9, 10, 12%, and everyone's going to be like out in the streets foreclosed on and sitting in bread lines. It's just like, it's not politically palpable. It doesn't mean that you can't have a lot of pain. It doesn't mean you can't have another drawdown of 10, 15, 20%, move sideways for a decade. It doesn't mean any of that can't happen. In fact, I think that we're getting closer to that financial mishap that's actually going to create the next leg down. So those are kind of the things I'm looking at. Very, very important signal. Really putting our whole thesis together. But there's a couple other updates on the mortgage side in Canada. So we have some of the Canadian banks actually will be coming out with stricter lending standards in October. That hasn't been publicly announced, but this is the whole point of the show, is being able to provide my insights with you guys. So there will be some Canadian banks coming out tightening underwriting standards, and this really coincides with the environment that's going on, right? Like interest rates are up, markets are blowing up. It's not just the UK. You've already got the Bank of Japan still doing QE. The Bank of Korea, another highly indebted household sector, is now actually stepping in with QE. So this is all sort of reaching this crescendo where, again, banks are obviously pulling back. They're tightening lending standards, as they should and as they always do in these downturns. And so that could potentially exacerbate things. We also had one of Canada's biggest private lenders halt investor redemptions, which means they basically gated funds and said, hey, listen, we know that you invested into this MIC, this private lender, but we need to gate our funds. We can't have people simultaneously pulling funds out and basically losing liquidity. So the main thesis here is liquidity. And we get to liquidity. I'm here in Greater Vancouver. You guys know, day-to-day practice as a realtor here. We are looking at a 30-year low, 30-year low in Greater Vancouver home sales for the month of September. So I have data personally that I run in my models. We have data that goes back as far back as 1992. I wish I could go back further, but the data starts to get quite choppy. So if I go back to 1992, which is 30 years of data, there's never been a September that has had fewer home sales in Greater Vancouver. So I think that is pretty telling when you say, well, how much has population grown over 30 years? How much is the housing stock? I mean, like, half these communities in the Lower Mainland didn't even exist in the early 1990s. I mean, if you go look at a picture of downtown Vancouver in 1992, you had, a dozen high rises and the rest was undeveloped land. I mean, more or less. So the fact that you're running sales volumes below those levels should really tell you that, again, lack of liquidity. What we ultimately have is a very low inventory base and listings that are actually being pulled off market out of frustrated sellers that's actually supporting the pricing right now. And then to get to that point, again, when we say, well, we're not adjusting for population growth, I mean, let's just talk about population growth for a minute, because it is off the charts, quite literally, a 50-year high in population growth in Canada right now for the second quarter of 2022. So a 55-year high officially for population growth in Canada. Again, the human stimulus, basically, we talked about this on the Loonie Hour. When you're importing, when your population grows 1.8% year over year and you import a record number of people, that impacts your GDP. It basically masks over a recession, which we would already probably be in. And it certainly provides, let's be honest, it certainly provides a floor under housing. I mean, if you're importing a record number of people, at the end of the day, it does provide a floor under housing. Again, I'm not saying this that house prices aren't going lower. They are going lower. I'm just saying, I think if there's a larger view here to get bullish, I would like to paint you a certain scenario from a longer term perspective. Again, I think this bull market's going to play out, or this bear market's going to play out potentially over several years. But let's just get into this for one moment here. Is what's happening feet on the ground is, as we can see, banks are tightening credit. We're seeing basically financial risks developing all around the world. Interest rates are going up, highly leveraged sector, housing sales in Greater Vancouver running at 30-year lows. What do the developers do? They're pulling back. They're throttling new housing supply. So you know that supply that all the big banks, and again, you might not believe the supply argument. That's totally fine. I think it's relevant. I think it's obviously hyped up by the industry, but I do think underlying it, there is supply issues in parts, and only in parts of Canada, particularly the two major metros of Vancouver and Toronto. If there wasn't a supply issue, I would argue that rents wouldn't be going up at the pace that they were, despite what's happening in the resale market. So I think you have this underlying supply issue in these two markets, and developers are now completely throttling supply, and yet you have record immigration that is currently underway. And again, I don't think this pace of immigration is sustainable. I mean, growing at nearly 700,000 people on a year-over-year basis in Canada, nearly 700,000 people year-over-year in Canada. Again, I don't think that's sustained. A lot of that is going to be from people in Ukraine, obviously migrating here. We've had a lot of return of the foreign students, this post-COVID, getting back to universities. But I think ultimately the immigration is going to provide a floor longer term. So we are going to run into this scenario. And I would say that's probably a 3, 4, 5 year story where, okay, developers that pause projects today, when they start throttling supply, that becomes more of an issue 4 or 5 years down the road. So that's kind of how I'm looking at things, trying to understand the bigger picture. But again, just to put in context, 700,000 people nearly growth across Canada. And we're running basically at 30-year lows in Greater Vancouver, 20-plus years low in home sales in the GTA. So it really kind of puts things into context of where we're at. As I've said before, I've written pieces about this. I think the housing market is weaker than policymakers are made to believe. But I think we're starting to see that it's becoming extremely challenging to actually normalize policy without governments getting the itchy finger and hitting the panic button and bailing people out. And not to say that's the right or wrong thing, but the pension system globally is about 35 with a T, trillion dollars around the world. So it is systemically important. And so you can only imagine people that work for 30, 40 years only to find out that their pension fund became insolvent. Would not go over very well when you consider the fact that governments are actually printing money to fight inflation right now. They're actually mailing checks to people. So nobody seems to want to actually accept any pain in this environment in society today. So that's kind of how I'm looking at things right now. I think that we're going to continue. Again, the central banks are not pivoting right now. They are not pivoting. The Fed is going to still hike rates in October. The Bank of Canada is still going to hike rates in October, barring some another huge crisis in the next 3, 4, 5 weeks here. But things are mounting, and the more that rates go up, the more that things will be breaking. So hope that helps.